G'day, Binanceans, and welcome to this week's Binance Beach. I'm your host, Liam, and I'm back this week with a Bitcoin versus Aussie property analysis. We love property in this country. It's one of our favorite investment vehicles. And I recently appeared on Tom Mitchell-Hill's podcast, the NGMI show. And I'll drop a link to that in the show notes. That episode was titled The Great Asset Debate, Bitcoin versus Australian Real Estate. And it's been doing quite well on YouTube. So I thought for this week's episode on our show, maybe I would jump in and do a bit more of a deep dive on Bitcoin versus Aussie property and which is or how they compare as investment options for investors. Yeah, of course, guys, before I start, actually, please like and subscribe. I don't usually do strong call outs for that, but I would super appreciate it if you guys stay in touch with the show on YouTube by, giving us a like, giving us a follow. And of course, I really want to hear your opinions too. So comment, let us know what you think about these ideas, whether you're more in favor of Bitcoin or you're more in favor of Aussie property. Give me your thoughts and feelings. I would love to hear them. But yeah, Bitcoin versus Aussie property. Let's jump into it. So I'll start at the start. I think when you're listening to people's opinions, because that's what they are, these are just my thoughts and feelings. It's important to understand where they come from. So I hold both Aussie property and Bitcoin, but I'm not a whale for either asset. I'm just a normal guy trying to make it for his family, trying to build financial independence, financial freedom, and, hopefully spend some time with my kids when I eventually have kids. I don't have kids right now. But when I have kids, I want to spend some time raising them. And to do that, you've got to set up a good platform. And for so many of us right now, it is a real challenge getting ahead as young people. That's my background. Just a normal guy trying to make it for his family and create opportunity for myself to have a family in the future. Obviously, I work at Binance. I work in marketing. I'm not an investment manager. I'm not a fund manager. I'm the CIO or anything fancy. I don't have a high finance background. I'm not an economist. I'm just a normal dude. And of course, Binance is a crypto exchange. So, we have a product that supports one of these asset classes and not the other. So that's an important bias to note. The scope of this discussion is for an investment property, not for buying what I think the property podcast called PPR, primary place of residence. If you're buying a house to live in, that's different decision to where do I allocate capital? How do I allocate my capital as an investment for long-term growth? So this conversation is purely around capital allocation, not around I'd like a house to live in. I mean, I got mates who are using Bitcoin or using crypto as savings vehicles or investment vehicles to try and work towards that, house deposit. That's actually something that's really common amongst our user base. We see users a lot, saying that they're using crypto or using other investments to work towards a house deposit because there's such a big thing to save for. But, that's not the scope of this discussion. That's a very individual decision, whether you buy, whether you rent, where you buy, how you buy, completely different to allocating spare capital for long-term growth. My analysis here isn't perfect either. I've just pulled from greater thinkers than myself on Twitter, across other channels. I'm trying to pull data from CoreLogic or the Fed. But my analysis is directional. I haven't run the numbers in this presentation on price predictions or, CAGR, outcomes. Like, this is about understanding both asset classes from a fundamental perspective rather than like laying out an investment case for one or the other. Of course, not financial advice. BYOR, what's right for me or for other people might not be right for you. And my graphic design skills suck. So give me heaps of feedback, but not a graphic design. Save that for someone else. There's two ways to look at this comparison. There's supposed to be a house emoji there. I hope my house emojis appear. Bitcoin versus housing. And the first way to look at this is just purely from a numbers asset performance analysis, comparing each asset based on its historic performance, the costs to hold the asset, because of course, your end profit from a trade or an investment is your appreciation minus your costs, and then looking across the risks of both assets, which I think is an important part of being informed about where you allocate your capital. From a historic, emojis are not going to appear, which sucks. Bitcoin on the left. Um, from a historic perspective, both assets have ground up and to the right pretty significantly over the lifetime of this analysis, right? Bitcoin's been around since 2008, 2009. This Fred chart on the right is residential property accounting for inflation, so it could probably be a bit more exponential if you put if you don't adjust for inflation. There would probably be a bit more of an exponential curve. But that's Australian residential property prices since about 1970. Of course, we know that 71 was a pretty key date in the monetary history. So that chart nicely illustrates the growth of Australian residential real estate. Particularly seems to have really picked up, even in inflation-adjusted terms, since about the 2000 mark. And I mean, if you hang around on Aussie Property Twitter, you see those hilarious old videos of people complaining about how high prices were in like the 2000s or even back in the 90s. And they seem pretty funny now when people are saying, "Oh wow, I have to pay $50,000 for a block of land," and you're like, "Oh, wouldn't that be nice? Must be very nice." Anyway, key takeaway here is both have grinded up and to the right when you compare them in dollars. But I think as we look at the annual average rate of returns for both of these, there is a pretty stark difference. Over the past 10 years, Bitcoin's delivered about an 80% compound annual growth rate. Australian residential property averaged about 8%. And so, while Bitcoin has been pretty volatile, if you held it for a period of 4 years or more, and you did take advantage of that long-term average returns, then, you could do up to like 10 times better than Australian property. What is important to note on the flip side of that, though, is of course people trade property with leverage. As a retail investor, there aren't many places you can trade in Australia with leverage, but property is one of them. And when I say you can trade with leverage, I mean you can go to the bank and you can put down a 10% or a 20% deposit, and they'll give you the remainder of the capital required for you to buy that asset and speculate on its future value. Of course, you could have traded Bitcoin with leverage. You might have got wrecked, you might not, depends how good a trader you were. But with the significant drawdowns that Bitcoin has had in a number of years and the volatility of the asset, leverage was often a way to get wrecked and lose your position. And on residential real estate too, you don't really face a margin call, which is quite an interesting way of looking at it as well. You might face, if you lose more than 20% equity in the property, you might have to pay LMI. I'm not even really sure how that works, to be honest. But the key point being that, you can trade property with leverage. And so that 8.0% average return might be a larger capital amount. If you're investing cash into both assets and not taking leverage, then of course Bitcoin is a much stronger performer if it is a little more volatile. But I think when you look at the cost to hold each asset, there's a really clear winner here as well. I just asked ChatGPT to bang me out a really quick scenario just to illustrate the costs. Don't take these numbers as gospel. Every situation and property is different. But let's say you've got 200 grand and you can either put down 20% deposit on a $1 million property in Sydney, might be a bit ambitious, or 200K or the Bitcoin just held in self-custody. When you look at the cost of the property, they're pretty significant. There's two layers to that cost as well. There's the acquisition cost, which for property is quite high, stamp duty, mortgage brokers, fees to the bank when you are getting the mortgage set up, fees around the sale, maybe use a buyer's agent. You can spend quite a lot on acquiring a property. But to acquire Bitcoin, you can go to a platform like Binance and you can trade from USDT to BTC for a 0.1% fee. So on a 200K purchase, that's $200 fee. So very, very cheap to acquire. Even you could be looking at up to 0.5, like maybe you really stretch it to 0.1 if you want to look at a custodian or if you consider spreads when you're onboarding. But it is relatively very cheap to acquire that Bitcoin investment and move it to self-custody versus acquiring that property investment. Much, much, much more capital required up front. Now, of course, you can go into, waive stamp duty exceptions. Now we've got the 5% deposit guarantee. I don't want to, again, my analysis is not perfect. It's directional. It is far more expensive to acquire property than it is to acquire Bitcoin. Then there's the barrier to entry element of that as well. Of course, you can only buy a property when you get together a deposit. You can buy parts of a Bitcoin for, $25. So you could be investing over the period of time that you would save for an investment property deposit and maybe take advantage of some compounded returns there as well. But in terms of the holding costs, which is more the point of this slide and the comparison, if you want to, you can theoretically hold Bitcoin indefinitely for a cost of zero once you acquire it and move it into self-custody. Even if you are buying hardware wallets, you can also set up software wallets for a cost of zero using open source software. You can drive that, the erosion of your capital from a Bitcoin perspective, very low to nothing. On a property, and like I said, I do hold an Aussie property. The costs are can be pretty astronomical. In this scenario, ChatGPT ran out, about $40,000 gross before vacancy and unforeseen expenses, and that's a fair bit of capital to have to stump up every year. If you can cash flow that, then good for you. But I know it does require a fair bit of capital. Then you've got tax advantages, which I haven't put in here. Again, this analysis is directional, not perfect. So you do get, tax benefits from negative gearing. They're in place right now. They might not be in the future. Who knows? That's not a guarantee, depending on which jurisdiction, state. Who knows what, jurisdictional changes could impact. So key takeaway here being that the cost to hold Bitcoin is very, very, very low. It doesn't erode your capital over time. Cost to hold real estate is much higher. Then when we look at the risks to each asset, this is very much a DYOR, but I think it is important to consider that both assets have their own unique set of risks. Of course, on the Bitcoin side, you've got volatility. If you hold for a long enough period of time, historically, you've done quite well. But if you are someone who's more emotional with your trading and short-term thinker, that might be harder to stomach. Then you've got custody risks, regulatory risks, protocol technology risks, perception risk, XYZ. I think you can do your own research on Bitcoin risks. And on the property side, of course, similar kind of thing, tenancy and vacancy risk, interest rate risk. You don't have, in the case of Bitcoin where you just buy and hold spot, you don't have any ongoing fee changes. You can hold that indefinitely and know exactly how much it's going to cost you. With interest rates, you don't know, it might impact your cash flow ability to hold over a long period of time. Same thing with regulatory government policy risks. Things can change over time in different jurisdictions. The liquidity risk is an interesting one. Bitcoin is super liquid, can be sold almost instantly for a very low fee from anywhere in the world. It obviously takes quite a while to sell property, and the costs to sell are very high. your concentration risk on property too. You have one asset. I think you could argue you have concentration risk on Bitcoin too if you've only got one asset. Maybe that point is a bit less relevant there. And then you've got your unforeseen kind of disasters, natural disasters, tenant damage, unexpected repairs. They hit you hard. I had to replace an aircon last month, and that was a bit of a stinger. Anyway, DYR and these, I guess, from a risk perspective, both have their unique set of risks, and it's probably more important to consider which set of risks better sit with you rather than declaring a strong winner here. So that's the first way to look at it, is on a objective numbers perspective, which has the better historic price performance. And I'm not going to make price predictions here or try and extrapolate out those growth rates or anything like that. You can do that yourself. That's great research for you to do to make your own investment decisions. But pretty clear that the Bitcoin as a when you look at the historical performance of the asset over time has performed much better than property purely on a numbers basis, and has a much lower cost to hold. The risks you can consider for yourself. Then you come to the second way, and maybe more of like a Bitcoiner way of looking at this, is to consider this from a perspective of like, what is the better money? What is the savings vehicle? I think for me, comparing Bitcoin to Aussie property as an asset is one way you can look at it, but I much prefer to compare the Aussie dollar to Bitcoin as a savings technology and as a monetary technology. And I think for me, that's kind of the more relevant way to look at this rather than just trying to compare property to Bitcoin. So from this perspective, we'll have a look at why do people actually invest in real estate? Like, why do people put money into houses in Australia? We'll look at houses priced in Bitcoin, and then talk about protecting your purchasing power and this idea that houses could return to their utility value. So why do people invest in real estate? This is for me like a pretty important question to ask. Why are people taking their Aussie dollars and shoving it into houses, into investment properties? Why are people doing this as a business on the side, which is essentially what it is. You can look at it as an investment, you can look at that as a business. And why are people doing this instead of arguably more productive businesses? Like, it is important to have a supply of rental properties so that people can rent instead of buying, and the market will naturally create that demand to meet that create that supply to meet that demand. But why is this such a huge trend in Australia? Why is this such a cultural phenomenon that we jam money into property instead of saving it in Aussie dollars? Well, of course, inflation erodes cash savings. A dollar in the bank today buys you less tomorrow. If you sat on your $200,000 deposit from that earlier scenario and didn't do anything with it, didn't put it into Bitcoin or didn't put it into into property, and you had that pre-COVID, you would have 25 to 30% less purchasing power over the last 5 years, depending on which metrics you use and how you look at it. Even using kind of official RBA inflation statistics, you will have lost a fair bit of that purchasing power, and you'd be getting a lot less Bitcoin and a fair bit less Aussie Aussie bricks for your money. But Aussie property is historically, again, this analysis is not perfect, it's directional. It's either equaled or outpaced inflation, which helps preserve purchasing power. And the point I made before too is it's traded with leverage, and so people have seen pretty significant growth or gains in absolute dollar terms when holding property over a period of 10 or 20 years, because that leverage really helps them compound that capital growth. Of course, the scarcity in property, there's cultural and generational trust in housing in Australia. I've talked a little bit about that culture of investment, and I talked a fair bit about that with Tom. So if you're interested in hearing more about what I think there, check out that pod. And so I think this is really the key takeaway, that property has become the default savings account for Aussies, not just a place to live. It's no longer a utility. It's no longer a functional product that you can buy to buy somewhere to live. It's now the savings account, a savings vehicle for Australians. And you can decide for yourself what you think the ethics of that are. I'm not going to jump into that. There's a good, actually, I might just cover quickly this great tweet from Rahat, who's a pretty well-known Bitcoiner. Inflation is a great way to transfer purchasing power from people who hold government-issued currencies to people who hold assets. Very clearly, that's been a phenomenon that's happened in Australian real estate. And here are the charts to show it. Property prices increase with the money supply. Good bit of analysis from Bico. So as the money supply increases, so do house prices. Again, this chart, these lines are charted on separate scales. So, you can chart it differently if you like, but that directional analysis is really clear. As the money supply increases, so do house prices. And this is a funny little meme. Boomers thinking they're good at real estate inflation. I thought that was pretty funny. So drop that in there as well. And so if you consider Australian property as a savings account, as a savings technology, rather than like looking at these as two assets that you can invest in to be rich or make money, then I thought this was, again, like an interesting way of looking from a fundamental basis at the differences between using Bitcoin or an investment property as a savings account, as a savings technology. The graphic on the left comes from a Fidelity report. Fidelity being one of the largest asset managers in the world, and as of recently an issuer of a Bitcoin ETF, along with heaps and heaps of other ETF and financial products. And then I used ChatGPT just to whack out a quick kind of comparison and add property to this analysis. Of course, we've got gold, which is historically money. It's been our human sound money for 5,000 years. Bitcoin and fiat there. Comparing these as savings against property across these key factors for what makes a good money, or key fundamental elements about what makes a good money, what makes a hard or a sound money, what makes a money last over time. Durability is the first one. Of course, gold and Bitcoin score quite well on that. They protect purchasing power. They are very durable. They last for long periods of time. And I think the durability here in the Fidelity report is referring more to protecting purchasing power rather than literally the physical durability of the asset. But gold is very durable. And so far, Bitcoin has been very durable in its relatively short lifespan. Fiat is not durable. Fiat does not protect purchasing power, as we've kind of illustrated in that previous slide. And property has been pretty durable, has protected purchasing power, has done a pretty good job of keeping things stable in terms of purchasing power over time. Now, in terms of physical durability, I think it probably doesn't perform as well as Bitcoin or gold. Obviously, there's damage and capital erosion when you need to replace things, fix things, replace tenants, XYZ. So there's a fair bit more capital erosion than there is with Bitcoin. Gold, you can argue capital erosion every time you have to move it, and potentially capital erosion to store it. You might need security, you might need vaults, you might need a custodian, but won't go too deep into that point. Divisibility, gold is not very divisible, doesn't really win on that, neither is property, but Bitcoin is and fiat is. They're highly divisible. That's a pretty easy one to kind of visualize there. You can't cut up a house into pieces. Fractional real estate aside, which I don't know if that trend's really taken off. I don't know if the fractional real estate thing has ever really taken off in the way that maybe some of those founders or really thought. What's this one? I can't read it. Fungibility. There we go. Sorry, my slides are a bit small on my screen. Fungibility. This one refers to basically. I might make this bigger, make it easier to read. Fungibility is about how kind of liquid it is, how easy it is to trade. Gold is very fungible. It's recognized as money all over the world. Bitcoin is highly fungible. Again, it's far more liquid than gold, far more liquid than dollars. You can trade it across hundreds of platforms for a pretty accurate market price, 24/7, 365. You can do that on centralized and decentralized, or you can do a peer-to-peer. Very, very liquid, very, very fungible. Fiat is not. Your Australian dollars don't have any value in another jurisdiction. You need to find someone specific to swap it and charge you an exorbitant fee. Property is not that fungible. Houses are not identical. One house is unique. And while you can kind of have suburb profiles or look at groups, 3-bedroom here, 2 bath, cannot be moved. Gold property cannot be picked up and taken somewhere else easily. I mean, you put a house on stilts, but that's kind of a dumb way of looking at it. Gold you can move, but it's incredibly expensive to transport gold. So heavy, requires security. If you want to transport, $100 million worth of gold, very hard to do. $100 million worth of Bitcoin or fiat, arguably much easier to do, access across space as well as time, which is kind of your durability. Verifiable gold is very hard to verify as individual. You look at the gold bar, very hard to tell if it's actually gold wrapped around something else with lead in the middle. Whether it's gold at all, or it's just a yellow colored something else. Fiat as well, the supply of fiat cannot be tracked. Like even the Fed doesn't know how many dollars there are in existence, which is kind of wild given that they're supposed to be the issuer. But with things like fractional reserve banking, $0 system, then there's no way to really verify the supply of fiat or have any, assurance on the supply in the future as well as currently or in the past. So it's caused a negative there. Property, I mean, ChatGPT gave it a yellow. Depends. I think when I was talking to someone about this just recently, like property is very verifiable through a deed for 50 years, 100 years until you reach significant turmoil, and then at that point the political turmoil or instability at that point, property is not very verifiable, right? Like if you held property through the French Revolution, through the Arab Spring, through any of these kind of like major political events, then suddenly your ownership of property was not very clear, and the system of property rights that defended your ownership of property, suddenly disappeared. And so while it is definitely verifiable within a jurisdiction when there's jurisdictional change or those kind of black swan once in a 50, 100, 200-year event, depending on which country you're in, then, suddenly that's not quite as clear. It becomes very fuzzy very quickly. Scarcity, gold, Bitcoin, of course, very scarce. Gold's inflating about 2% supply per year. Bitcoin at its pre-engineered rate of inflation, diminishing supply coming online, and 21 million cap. Fiat is not scarce. Property is pretty scarce, so gets a tick on that one, particularly if you can buy property in desirable locations. And then there's the track record. Gold has been analog money for 5,000 years. Bitcoin and fiat are relatively recent phenomenons. Fiat has a terrible track record, of course, of hyperinflating. A really interesting thing I did the other day was look at hyperinflationary events over the course of the last 100 years. It's quite an interesting exercise to go through. Ask ChatGPT or do the research yourself, do the legwork, just to list out all of the hyperinflationary events in the last 100 years or the devaluation events in the last 100 years. Pretty wild. There's pretty much one every 2-3 years at best. So, yeah, I mean, comparing Bitcoin versus investment property and gold and fiat as, a savings vehicle, as a savings technology, I think Bitcoin's pretty clear fundamental winner. Gold and property tick, call it 4 out of 7. Fiat ticks 2 out of 7. Bitcoin ticks 6 out of 7. So from a fundamental perspective, I think that gives you a good understanding or a good perspective on, how the fundamental store of value qualities of these assets differ. Gold is hard money. As we kind of point out, like gold has been the analog money for 5,000 years. Throughout human history, we've reverted to gold whenever we've had fiat fail. And so I show this tweet to people often when I'm kind of talking to them about money and, having that discussion about what is money and how does money work. And for people, normies I talk to who kind of haven't really considered that in general, who are on the treadmill trying to figure out how to buy their first house, how to get through the groceries, to how and get towards financial independence and freedom, and feel like they're going backwards. The wages are getting, relatively lower. Wages are stagnating. This is often the tweet or the graphic that I show them that kind of helps it click. And of course, like, this is not a perfect analysis. This is directional, but gold has been a very functional store of value over hundreds and thousands of years. And fiat has not. And so the question that this has, I think, forced people trying to wrap their head around what is going on and why it's so hard to buy a house these days is, the question that this forces them to ask is, well, if the houses haven't changed in gold terms, why are they changing in fiat terms? And you can go down the Bitcoin rabbit hole from there, or you could go down the gold rabbit hole and be a gold bug. But I think this often is a bit of a click moment for people, understanding what is hard money, what is sound money, and why fiat is not hard money. So gold is hard money, but Bitcoin is harder money. If we compare these charts, gold price in Aussie property, price in gold, price in fiat, price in Bitcoin, it's almost like the three kind of charts you could have. Aussie property on the left here, pumping in fiat, like up and to the right. With gold, it would be flat, for argument's sake. And in Bitcoin, there's a very clear down and to the right trend. Prices are getting cheaper when priced in Bitcoin, and they're getting more expensive when priced in fiat. And they're probably staying around the same when pricing gold. I don't have that chart, but I'd love to get it if somebody has it, on hand. So which monetary system, if we think about what is money and which money you would like to use to store your value over time and space, which which do you want to use to, store your value, whether you're saving for a house or, whether you're looking at preserving your purchasing power? Is it a system with infinite monetary units requiring you to store value in other assets with important utility and utility value to society? We all need houses to live in. Or would you rather store your value in a monetary base unit with, a scarce supply cap, be that gold or Bitcoin, where holders don't need to protect purchasing power by moving their capital into other asset classes? Yeah, pretty clear way of looking at it. I think this is the core of that alternate perspective, other than just looking at where should I park my money to get rich? Like, what should I buy to make more money? It's like, where should I store my value? Where should I store, my productivity, the things that, I've been paid for delivering in the past, for my work, for my contributions to society? Where should I store that purchasing power to protect it and grow it over time? Rather than allow it to be inflated away. These monetary systems are very clearly different in the way that they do that. And so that lands me to, this idea which has been presented by, a lot of sound money advocates, and particularly, I think, a lot of Bitcoiners, has been this idea that housing could, over time, return to its utility value. Rather than continue to go up in value. If you store, well, if we are able, as a cohort, as a group, to store our value somewhere else other than property, which is currently our savings account, then potentially the monetary premium or the additional, I guess, like price that is attached to Aussie Property beyond, the functional utility value of that as a piece of shelter, might be eroded over time. Let's dive into that point. I don't know if that explanation was fantastic. Let's kind of start again on this. Aussie Property carries a monetary premium because people use it as an investment vehicle. There's additional demand, additional dollars, additional buyers in that market who are there for investment to protect their savings from inflation, rather than there for simply utility value, or for functional business value, right? To run an investment property like a business. People are using this as a long-term speculation or store of value. And that obviously drives prices up. That additional demand increases prices. Under a Bitcoin standard, or even a gold standard, arguably, if you're a gold bug, using a hard money, savings can migrate to Bitcoin as a superior store of value, rather than be required to use property as your investment vehicle to store value over time. And without that demand, then housing prices could fall to reflect their utility value, shelter, lifestyle, location, rental income, rather than being pumped by having a monetary premium, by having a additional source of demand as a savings account. House prices could fall to reflect their utility value. And then property will stay valuable, right? Property will still be an asset, be valuable for living and renting, but loses its role and its monetary premium as the go-to savings vehicle for Australians. And so this idea that property could return to its utility value under a Bitcoin standard essentially can be summed up with this statement, right? Bitcoin absorbs the store of value demand. That demand no longer goes to the Aussie property market. Sorry, cameras everywhere. And homes can not be financialized vaults, cannot be store of value, assets long term, and go back to utility value. And I think a lot of people have made a case that that's a far more productive, outcome for society at large, and particularly young people who, haven't engaged in this system. So yeah, I mean, how much monetary premium is in Aussie property? I mean, I'm not going to try and answer this question again. Directional, not perfect analysis, but when we have 5 of the world's 15 most unaffordable housing markets, you look at our housing and equity market size relative to GDP, very clearly there is an enormous monetary premium in Aussie property in this country. You can try and measure it yourself if you'd like. I'd love somebody to do some work on that or share it with me. And so again, like the question people ask, with Aussie property, like, will the bubble pop? Is this Australian real estate bubble going to pop? Is it going to pop like Japan or some other markets? When does this end? How more unaffordable can it get? But my counter to that, or my comment to that, is maybe the bubble already has popped, and it's not about the bubble popping in Aussie dollar terms, because that is a currency that can be inflated to infinity. That can, the supply can go to infinity. But when you look at sound money, or the hardest money that we have access to as Aussies, Bitcoin, maybe that bubble has already popped. And I think the way these charts kind of almost can be crammed together to be up on one side and down up in fiat and down on the other side is quite an interesting way to look at it. Maybe the bubble's popped, just depends on your denominator. Maybe there's more than just 2 sides to the Aussie property trade that you could be looking at. So that's me today. Of course, I'm not going to jump into price projections or trying to extrapolate stuff out. I think this discussion is really about the fundamentals of 2 asset classes and considering them on their basis. Please give me your opinion. I'd love to hear it. Do you agree? Do you disagree? Give me questions, give me feedback, and yeah, it's fun doing these solo episodes. They really challenge you to put together a cohesive argument. So let me know if you like these, and I'll try and do more. Please like and subscribe, and of course, do your own research, do your own numbers, and think about what is best for you. That's me, Binance. Have a great rest of your week. Hopefully, you get some waves over the weekend. I know I'll be looking for waves. So yeah, enjoy. And I'll catch you soon, guys. Thank you so much for taking the time. Please note that this discussion includes insights from non-affiliated third parties and key opinion leaders. Binance provides this platform for informational and educational purposes only and is not responsible for any content or insights provided. This information should not be considered as financial, tax, or investment advice from Binance. DYOR Binance.